So that's the good news. Even better news would be bipartisanship. It's hard to believe it's possible. We are hearing more members of Congress, that is, talking about their desire for bipartisanship. So hopefully steps in the right direction at some point to get our government working again. So fiscal policy, the only other thing I'll say about this is we did get what the so-called Inflation Reduction Act last year. It was $1.7 trillion. And I was surprised that it did get through, but it did. And now everyone's heralding it as bipartisanship, which again seems to be becoming a buzzword because the electorate wants it. Of course, the bears on inflation and on the market are seizing that, running with it and saying, this is inflationary, this is inflationary. As I described, inflation can come in many forms. And as I'll describe later, we do not believe that it is going to cause inflation, is expecting 2% inflation for 10 years. And this is the Fed's goal. The bond market thinks we are already there. And in fact, we believe the bond market will continue to rally, meaning long-term interest rates coming down relative to short-term interest rates, inverting the yield curve. Right now, we're at 70 basis points, a little more than that. And it is interesting now to watch the bond market disengage somewhat from the Fed's rhetoric. The stock market has not done that yet. In fact, the stock market is behaving like the Fed is right. The energy sector is reaching for all-time highs, even though oil prices peaked in 2008, and we believe are in secular decline. And we'll get into that in a moment. On February 1st, we'll probably see another 25 or 50 basis points. So we will be at 4.75 or 5%. Now, most of the Fed governors are saying roughly 5%, maybe a little bit more, and then we're done. Maybe the Fed will start talking a little bit more about some of the very significant declines in inflation and outright prices. Then productivity is increasing as well. And we've had a lot of dislocations associated with supply chains recently. So it's very hard to tell where we're going to settle out in terms of productivity. But we do believe if we're right on how much innovation is taking place, that productivity is going to start scaling in a surprising way and take the sting out of inflation fears completely. So just wanted to share that with you. Now on to economic indicators. I'll go quickly through this part. We did get the employment report today, and it had something for everyone. For those who think the economy is booming, the unemployment rate dropped from 3.7%, which was revised to 3.6, to 3.5. So back to the cycle lows. Non-farm payroll employment looked stronger than expected. I think 223,200 was expected, but previous months were revised down. So that was interesting. The other measure of employment that I've mentioned on this video a number of times is the household measure of employment. Now, it had been falling on balance since March of last year. Orders dropped 10 percentage points, very sudden and very rare for this index. And as you know, services are a much bigger part of the economy than manufacturing. So that drop off in orders is reminiscent of what we saw during 08-09. And not at all what we saw during the COVID crisis. So much worse than that. I think we're probably in response to that going to see more layoffs in the service sector and probably some of these employment metrics turning a little bit more negative. The orders number corroborates what we saw from factory orders for the month of November. They were down 1.8%. And even more important, the previous month was revised down from plus 1% to plus 4%. So again, at turning points, we look at revisions. And while we think that when history is said and done, the recession started at toward the beginning of this past year, most statistics are still conflicting. And so that's why I'm saying at turning points. I've mentioned this also before. We're seeing huge increases in consumer installment credit, the net change, 25 billion plus. Now, this is very unusual, except during periods when consumers are stretching. Consumer saving rate has dropped to 2.3%. It's very low by historical standards. It doesn't go much lower. And so what is the consumer doing? It is the consumer is buying more necessities, probably on credit cards, on installment. And that will continue to drive the saving rate down. So the saving rate is simply disposable personal income, which I just mentioned is diminishing in terms of its growth rate quite significantly, minus consumption. And so goods bought on debt subtract from savings. We got some bad sales indicators in the month. Retail sales down 0.6% for the month of November, going into the holiday season. We got some reports. We'll see what happens when the numbers are completely tallied, but it looks like online spending might have been down, negative. Certain categories certainly were down, and that'll be a first in the history of online. And of course, zero COVID is a reason for that. But I do believe China's been building inventories. And the reason it has been doing so is it's using the Russian war. It is buying oil from Russia at significant discounts. And we don't know how long this window will be open. The discounts reports are in the 30 to 40% range. So we would not be surprised to see inventories much higher almost everywhere in the world because of the war in Ukraine and the fears about not getting energy supplies, and China and India buying disproportionate amounts of oil from Russia. Russia doesn't have very many other places of size to sell that oil. Now, in terms of demand destruction, something interesting is happening here in the United States and probably elsewhere in the world. Many of you may have had this same experience. I was in California for the holidays, and I was taking Ubers. 3 Uber drivers were in Tesla cars.